Imagine having $127 billion sitting in your corporate checking account, completely liquid, and still deciding you need to go to the bond market to take out a massive multi-decade loan.
Which is exactly what Alphabet did in August 2026.
Right. The company was reported to be seeking between $20 and $25 billion through a multi-part U.S. bond offering.
And the maturities on this proposed debt stretch from 2 years all the way out to 40 years.
We are looking at a fundamental financial contradiction here. A company with a pristine balance sheet is actively accessing the debt markets at a time when, well, you would think they could just self-fund.
Look at the balance sheet reality preceding this bond offering. Top-line numbers present a picture of absolute dominance. I mean, Alphabet reported record quarterly revenue of almost $120 billion.
And within that specific figure, you have Google Cloud. That revenue rose 82%, bringing that segment to roughly $24.8 billion.
So the operating business is accelerating at a historic pace. But you have to look at the margin data next, specifically the corresponding expenditures that are completely offsetting that top-line growth.
The free cash flow.
Correct. Free cash flow for the quarter fell to negative $5.9 billion.
That structural inversion generating massive revenue while posting negative free cash flow is driven entirely by capital expenditure. Quarterly capex reached almost $45 billion.
And management raised its full-year 2026 capex outlook right on top of that.
We are now looking at an expected deployment of between $195 and $205 billion. For context, they could have bought an entire Fortune 500 company in cash.
Instead, they bought servers, concrete, and industrial cooling systems.
Right. Alphabet is not borrowing capital because its customer base is eroding. It is borrowing because the artificial intelligence race demands capital at a velocity that exceeds what even one of the world's most efficient cash-generating businesses wants to fund entirely from internal reserves.
Which establishes the core premise of this infrastructure build-out. We are accustomed to artificial intelligence being commercialized and sold to the end user as software.
But the capital cycle required to build, sustain, and scale it has become entirely industrial.
It requires physical chips, data centers, networking hardware, cooling systems, land, electricity, and continuous construction.
The end product is digital, but the underlying capital expenditure profile is purely physical.
Moving from the raw capex numbers to the strategic decision of how a corporate treasury funds this industrial transition, you have to ask why a technology company would choose to pay contractual interest to bondholders.
When it clearly has the internal liquidity to self-fund, Alphabet ended March 2026 with roughly $127 billion in cash, cash equivalents, and marketable securities.
A cash position of that magnitude raises an obvious objection from the equity markets. Why take on the debt?
Because holding cash and deploying cash represent distinct capital allocation decisions. Management can fund data center construction entirely through internal cash.
Or they can access the debt markets. They can lease the infrastructure. Or they can execute a combination of all three.
The optimal choice depends strictly on financing costs, the expected return on invested capital, and the degree of strategic flexibility the board wishes to maintain.
Alphabet's existing cash reserves have competing internal demands that must be protected. If they drain their reserves to build data centers, they expose themselves to operational vulnerabilities.
We can systematically itemize those competing internal demands. Alphabet must fund continuous research and development. They need capital available for future acquisitions.
There are dividend payments to shareholders, massive share repurchase programs,
strategic equity investments in emerging technologies, general working capital, and just the simple necessity of retaining a liquidity buffer against uncertain macroeconomic conditions.
If management were to fund every new data center entirely from internal cash, it would systematically reduce their optionality across all those other vectors.
Issuing debt allows the infrastructure cost to be financed over a timeline that better matches the asset's useful life.
Well, that assumes the underlying economics hold. Borrowing capital only improves the financial profile if the acquired asset generates a return that exceeds the cost of the capital committed to it.
Wait, I have to push back on that logic regarding the financing. Securing a low yield on a corporate bond does not magically transform an expensive, inefficient data center into a profitable asset.
It does not.
A cheap bond does not fix a bad asset. Financing costs simply change how the system is funded. The infrastructure must still generate enough economic value to cover construction, the accelerators, the power contracts, and future upgrades.
That is the structural reality.
Right, so if the revenue produced by that specific infrastructure does not clear those aggregate costs, utilizing debt does not rescue the financial return. You are just paying interest on a depreciating liability.
That is precisely the point. The underlying asset must validate its own existence. If Alphabet deploys billions in borrowed capital to construct new AI capacity, that specific capacity must generate sufficient economic value to cover the entire physical and operational system behind it.
Which forces the investor base to stop evaluating these companies purely on software metrics and start evaluating them on capital efficiency.
Google Cloud usage can accelerate. AI features can be integrated seamlessly. Yet Alphabet could simultaneously record a disappointing return on that incremental infrastructure if the capital requirement to facilitate that growth was simply too high.
Expanding revenue and contracting capital returns can occur simultaneously.
To understand why that risk exists, we need to track exactly where $1 of AI capital expenditure is physically deployed.
A significant portion is allocated to compute. Alphabet purchases advanced accelerators from external vendors while also deploying its own proprietary tensor processing units, or TPUs.
But the capital flow does not stop at the silicon. It flows into networking equipment, the specialized hardware that synchronizes thousands of individual processors so they can function as a single unified computing cluster.
And beyond the silicon and the network routing, the physical facility itself absorbs massive capital.
The data center requires industrial-scale power distribution equipment, complex liquid cooling systems, redundant backup generators.
Physical security infrastructure, the acquisition of the underlying land, the construction of the building shell.
And, perhaps most critically, securing a high-capacity connection to an electrical grid that is likely already facing regional constraints.
This physical deployment creates a severe timing mismatch between cash outflows and revenue inflows.
When we analyze the cash statement, the capital leaves the business immediately upon investment.
But the revenue generated by that investment arrives much later, if at all. A server cluster ordered and paid for today does not immediately begin processing a paid enterprise workload.
The lag is structural. A hyperscale data center project involves multi-year planning and construction cycles.
Permitting and electrical infrastructure installation frequently cause deployment delays.
And while the physical structure is being built, the technology intended to go inside it continues to evolve.
That dynamic introduces a critical operational distinction regarding diverging asset lives. Think of it like building a multi-million-dollar sports stadium, but having to tear up and replace the grass every single week.
The physical shell of a data center, the concrete, the steel, the core power routing, can remain structurally useful for decades.
However, the highly specialized compute hardware installed inside that shell evolves at an incredibly rapid pace and requires a much faster repeating replacement cycle.
Alphabet is not simply funding a one-time infrastructure build. It is committing to a repeating, capital-intensive replacement cycle.
This physical replacement cycle is exactly where traditional financial reporting metrics begin to distort the underlying economic reality. We have to separate the income statement from the cash flow statement.
It is like buying a $50,000 car in cash today. Your bank account instantly drops by $50,000.
But on your personal income statement, your accountant only recognizes a loss of $5,000 a year as the vehicle depreciates.
Alphabet is essentially buying millions of these depreciating physical assets right now.
Cash leaves immediately upon infrastructure investment, but accounting depreciation spreads the cost across future periods.
We can apply this directly to Alphabet's second quarter of 2026.
The income statement showed a record top-line revenue figure. Operating income remained fundamentally strong on paper.
But because cash left the business to fund roughly $45 billion in capital expenditure, the quarterly free cash flow was pushed below zero.
The income statement absorbs the expense slowly, while the cash statement absorbs the entire investment immediately.
That negative free cash flow print does not automatically indicate that the capital deployment was a failure. It indicates that the equity shareholders are bridging the financial gap.
They are funding the underlying economics of the infrastructure long before the full return on that investment becomes visible in the operating margins.
Consequently, macro strategists and institutional investors must adopt a new framework of institutional metrics. The legacy software evaluation models are entirely insufficient.
The new diagnostic questions are strictly capital-focused. How much operating cash is the business actually generating?
What percentage of that cash is immediately consumed by reinvestment just to maintain the current infrastructure.
What is the precise incremental revenue produced by this new debt-funded capacity?
How rapidly is the underlying compute hardware becoming obsolete and requiring replacement?
And ultimately, what is the final return on invested capital once all physical depreciation is accounted for?
Those specific metrics will dictate corporate valuations long after the August 2026 bond offering matures, which shifts our focus from the massive costs of the infrastructure to the demand side.
Management must justify this expenditure through specific monetization pathways. The bull case for demand is supported by the cloud data we reviewed.
Right, Google Cloud revenue expanded by 82%.
Alphabet has established channels to monetize this infrastructure. They have enterprise cloud customers, direct AI services, enhanced search capabilities, workspace integration, consumer subscription tiers, and targeted advertising products.
Additionally, their continued deployment of custom silicon could systematically reduce the reliance on external, higher-margin compute suppliers.
In this scenario, debt acts as a perfect bridge while future AI revenue compounds and grows into the expanded capacity.
Well, that assumes supply holds and pricing power remains static. The bear case models a scenario where the economics collapse despite rising demand.
AI adoption can continue to grow globally, but intense sector-wide competition could simultaneously drive the price of raw compute down.
We have to account for the efficiency contradiction.
I am stuck on a contradiction here. If AI models become more mathematically efficient, shouldn't that be a massive win for widespread adoption? Why would efficiency actually hurt Alphabet's economics?
Because efficient models reduce what customers pay per unit of compute. If an enterprise client learns to execute the same complex inference task using fewer computing resources, they pay less.
Efficiency is fundamentally positive for widespread user adoption.
But for the infrastructure owner, it applies deflationary pressure to their margins. Combine that with the fact that every major hyperscaler is currently injecting massive new capacity into the market at the exact same time.
New hardware deployments continuously reduce the premium value of older existing installations,
Which isolates utilization as the single most critical variable. The true standard for success is severe.
AI revenue must grow at a faster absolute rate than the capital required to serve it. If an advanced accelerator is continuously processing paid workloads for the vast majority of its useful life, it will generate an attractive financial return.
Conversely, an expensive, highly depreciating machine sitting idle because the broader industry overbuilt capacity destroys financial returns rapidly.
We must also expand this analysis from Alphabet's specific balance sheet to the broader technology sector because this structural shift involves massive macro leverage.
According to July 2026 Reuters data, Amazon, Alphabet, Meta, and Oracle collectively issued roughly $194 billion of bonds in a 12-month period.
That represents a 79% increase in debt issuance compared to 2025.
If you are holding index funds right now, you are holding this exact debt risk. Think about what an influx of high-quality corporate debt of that magnitude does to the fixed income markets.
Investors suddenly have a massive volume of corporate paper to absorb. That volume influences credit spreads. It dictates pricing. It alters duration preferences.
And it shifts how institutional portfolios allocate their capital globally.
But those traditional corporate bonds only represent the visible layer of macro leverage. The industrialization of AI creates a vast network of hidden leverage.
We have to expand the definition of debt beyond what is classified as a bond on the balance sheet.
This infrastructure build-out requires long-term data center leases, ironclad infrastructure commitments, non-cancelable capacity agreements, and multi-decade power contracts.
Right, a corporation does not need to formally label an obligation as a bond for the cash outflow to become completely fixed.
If a technology firm signs a definitive long-term lease for a hyperscale facility, that liability operates like debt. Once that contract is executed, the firm has legally committed future cash flows.
This specific capital profile is why big tech is beginning to structurally resemble entirely different sectors.
You might be wondering why a software company is suddenly acting like a heavy industrial manufacturer.
They are taking on the financial characteristics of telecommunications networks, regional utilities, heavy energy infrastructure, and semiconductor foundries.
In those legacy industries, competitive advantage relies entirely on the corporate treasury's ability to finance massive, fixed physical assets years before the corresponding revenue fully materializes.
Alphabet is not literally becoming a regulated utility, but it is adopting the capital allocation challenges of a utility, operating within a sector that historically enjoyed frictionless, high-margin software economics.
That structural shift dictates who capitalizes on this debt-fueled capex immediately. The supply chain beneficiaries receive their capital long before the hyperscalers see their final return.
We can trace that capital flow sequentially. The immediate winners are the hardware and infrastructure vendors.
Advanced chip makers receive massive guaranteed orders. Networking suppliers move high-margin routing equipment.
Electrical manufacturers secure long-term contracts for industrial switchgear, transformers, and power distribution systems.
Commercial construction firms are contracted to build the physical shells. Regional utilities gain massive, consistent commercial customers.
And the underwriting banks collect fees on the debt issuance.
Note the risk distribution in that sequence. The suppliers are compensated immediately upon delivery. The bondholders are guaranteed their contractual interest payments.
But the equity owners, Alphabet's shareholders, hold the entirety of the residual economic risk.
If AI monetization exceeds these massive capital outlays, the shareholders capture the margin expansion.
If the infrastructure remains capital-intensive for longer than projected, the free cash flow absorbs the pressure and the equity valuation contracts.
Ultimately, the entire financial structure has an absolute physical limit.
A state-of-the-art data center packed with the newest custom silicon is completely useless without adequate electrical power.
Electricity is the ultimate constraint on the AI buildout.
Technology companies whose core assets used to be algorithms, code, and intellectual property are now forced to navigate the physical complexities of securing dedicated megawatts, acquiring vast tracts of land, and negotiating complex generation and transmission access with regional power grids.
Which brings us to the two scoreboards operating right now. The technological scoreboard is public and highly debated. Who possesses the most capable models?
Who has the lowest latency? Who has the most accurate inference?
But the financial scoreboard dictates long-term survival. That scoreboard asks, who can efficiently convert raw capital into usable compute capacity?
Who can translate that usable compute into durable customer demand?
And critically, who can convert that customer demand back into unencumbered free cash flow?
The stronger outcome is straightforward. Enterprise and consumer demand scales aggressively. Alphabet successfully fills the physical capacity it is financing. The cloud segment expands its market share. The return generated by this new capacity clears the weighted average cost of capital, and free cash flow sharply recovers as the initial construction cycle concludes and revenue scales.
Under those conditions, issuing debt while the corporate credit profile was pristine represents disciplined, optimal capital allocation.
The weaker outcome represents a severe capital trap. Capital expenditure remains permanently elevated because the hardware requires continuous expensive replacement. Industrial power and physical construction costs remain inflationary. Competitors simultaneously overbuild capacity, creating a supply glut. Pricing falls, and debt and leases become fixed claims on cash that management cannot easily avoid.
Tell us which variable will matter most in the AI infrastructure race: demand, utilization, or free cash flow recovery. Subscribe to the Unlayered Global for more analysis of the money and physical systems beneath technology. For decades, big tech's financial advantage came from generating extraordinary cash with relatively little physical capital compared with traditional industry. AI is testing that advantage. The winner will not simply be the company that can spend the most on intelligence. It will be the company that can turn the most expensive infrastructure and technology into durable cash returns.